We just have a few minutes left, and I am talking also on Friday about grain marketing strategies. Mark Nelson with Farm Bureau will be part of that. We're following following with up on discussion by Brian Coffey of ag options as applied to the crop side. So, but today with what Jenny and Greg are talking about, seemed to be good to talk about the price protection net for corn and soybeans. And you have in the papers that I'd sent you, you have lots of detail. I would say almost excruciating detail in what is in there. So the summary is intended to spare you that unless you want to go into the details of it. There are some graphs that I hope to get to here that point out some interesting things as you look at the price protection net we have for corn as opposed to what we have for soybeans. And you'll see that as we get along here. So so we have a crop price and revenue protection net, and it involves various things. Of course, there's what the USDA provides, marketing loans, PLC and/or ARC County, revenue protection insurance, and also, though, what farmers of their own volition through the risk management strategies can put into effect. And it's not just the use of tools, it's the planned use of tools and the planned use of harvest, pre-harvest or post-harvest sales or harvest sales. And once you, and that's what we'll be trying to talk about in a organized, disciplined manner on Friday, second part of that session. Then once we figure out the overall parameters, what we're trying to accomplish, then we can get down to the business of looking at futures hedges or forward contracts. Of course, within forward contracts, the local part of the grain industry in Kansas, we're looking at basis and hedge to arrive variants of forward contracts. Just a matter of pulling those tools apart. And then ag options, puts and calls, that's also at play here. And there are other things, and I say other issues that increasingly we've got people, if you're talking about dairies or elsewhere, doing direct contract integration with different suppliers in an effort to not leave themselves vulnerable to market forces. So most of the time, ag producers aren't doing that, but you do hear of that happening sometimes. So our goal here in a few minutes is to assess corn and soybean protection net. And point of reference, we'll start with cost of production and look at cost of production relative for a couple applications. Kind of chose Salina, corn, non-irrigated corn and beans. You can see the yields there: 120 bushel corn, 45 bushel soybeans based off our KSU budgets. For irrigated corn, 225 bushel per acre corn and 66 bushel per acre soybeans, both of those out in the Garden City area. So I deliberately chose Western Kansas and more of a Central Eastern Kansas set of circumstances to look at. And we'll look at pricing and production opportunities basically today and late yesterday. And the key to compare the opportunities in the crop price production net for the relative benefits and costs currently or today. So, Greg, I sure know what you said. I pulled off with regard to corn from North Central budgets, Southwest budgets for non-irrigated corn in North Central, irrigated corn Southwest. I see the cost numbers. I wouldn't be surprised that inflation in the input costs, fertilizer, you name it, as we're clamoring for acres and inputs, that those numbers are probably low, but I don't know exactly how much. I wouldn't be surprised that the irrigated corn number is closer to 380, heading for $4 right now. But I'm not so sure about the non-irrigated North Central. I wouldn't be surprised it's 25 to 30 cents higher too. But those even if, given our markets right now, even if those prices are 25, 30, 40 cents low, still we have marketing opportunities in these markets that are tangibly larger, greater than that give us returns over those numbers. Forward contract bids yesterday. I note today that the corn market down about a dime, at least as we're just about at the end, I guess, for the day. But that anymore, that's kind of white noise in the corn market, ups and downs. But 456 in Salina, that's top bid out of the Salina area. 487 top bid available. Pull that off of DTN Grains in the Garden City area. You can go at the money, could go at the money yesterday, and for about 44, 46 cents buy a put option that would give you, and you combine that with the same prices on a basis contract, in essence, taking the basis bid out of the forward contract and using it here, about 404 for a put option price floor, and in the Salina area, and of course, positive basis out there in Garden City right now, 11 cents over. Yeah, 20 cents under for new crop in Salina, 11 over in Garden, and 435. So, you know, both of those tangibly, strongly above cost of production. The only issue that we're wondering about is, gosh, we don't have the crops planted yet, and it's pretty dry. So still though, right, as we sit today in for early March, we've got over $4 put option price floor situations. But there's a catch with options. You have to have enough rise in the futures markets to cover the cost of the option. So that's what we'll try to look at here. Marketing loans, we do have marketing loans, and really there are times when prices are low and they're relevant, but they're just not really even relevant right now. Probably something that will be a mind twister for you will be to see how I've handled revenue protection at different APH yields. And in so many words, so let's say, you know, take a look at this first box right here. There we go, right there. You see the USDA's price for corn's 458, and following Jenny's predecessor, Barnaby, we went through RAM workshops time and time again. And if you assume that the yields aren't changed, assume yields, what you know right now, your APH yield being the truth, or what you think it is, then over for 85% of your APH, you're getting paid off at 458. But what happens when you spread that out to 100%, to the other 15%? Well, you scale that price down. You have a net price over all your acres of about 389, and you can see that how that plays out. You basically take 458 times 8.85, you get that, times 0.8, 366. So to some degree, as you're making your decision to you know, as to what APH you're using, it has an impact on the revenue that you have out there. And if you assume regular yields, you've got an implicit price there. Of course, that's 65% APH, 0.65 times 458, you're basically $2.98 or $3. So most of the time, that's not a big thing. But if we could have by 80%, well, and you see the prices there. We're not going to go into this today, but you know, when you go from say 75 to 80% APH, you see a price difference of basically 22 cents. You're paying $12 an acre difference. Divide that by 120 bushels. You can figure out how much you're paying, how much implicitly in these insurance premiums you're paying for the option of having a higher price coverage. So that's some of the legacy of Barnaby and some of the things that we talked about in those days. And Jenny, welcome, you now have this legacy, so good for you. Anyway, so you can see that, and you see the various costs in the east and the west. Interesting that insurance costs in the central part of the state, at least as I found them, higher than for irrigation out to the west. And I wouldn't have thought that. So you want to trust but verify. And we also took a look at the PLC costs. Well, not PLC costs, at the PLC coverage course, corn 370 reference price. And so if you look at this range of things we're going to be looking at, you don't start to kick in until you get below that 370 price at that, and you're assuming the futures, or I'm assuming the futures and the U.S. national price are about the same. So, so that just with that, you can see where we're going. So, first of all, we'll just take a look at Salina, and you can see Garden City on the other side. You can see here that for the range of prices we're interested in, these corn futures, where they'll be in October from, say, most of us aren't even thinking about $3 or $3.50, but let's say $4 to $4.50 to $5, and then the Salina cash corn price at a 20 under basis coming in there. That you do see when you at this below $4, you've got the revenue coverage. If you spent the money to buy 85% APH, it would have some impact. It would have more impact than PLC, but you're spending a lot more money to buy that in your crop insurance. You see where the 75% APH comes into, and all these are looking pretty good relative to this red box down here, which is the cost of $3.15. This filled in area, that's a Salina cash corn price. Again, as futures go higher, and you assume a 20-cent basis, you're moving along in here. Eventually, you get high enough yields, then these or high enough prices, then the coverage you have down here just kicks in, and it behaves the same as the cash price going up. Again, it's a floor. So I understand this. I mean, I see this, I perceive it, I think I understand it. What I'm interested in is this next one. Yeah, right now we have forward contract bids. This was yesterday's bid, 456 as a forward contract bid for Salina delivery. A put floor of 404, and there's PLC down there at 370. The challenge is you had to spend 44 cents for a put premium and 2 cents for a broker to go basically from here to here. So the put wasn't exactly on the money. There was a little bit of variance up and down, so that's would account for the difference. So it seems like when you get above, when you this put, as it goes higher, it's always going to be below that forward, always below the cash price, because you had to pay the premium. And you're paying that premium. It's always going to be a penalizer. You're adjusting in the middle here. And but you know, this 456 forward contract price, even the 404 looks pretty good relative to 315. And let's say I'm way off. Let's say it's 350. It still looks pretty good. So I want to move on. In the time we have, take a look at, we're tight on time. Let's go to soybeans. Soybeans 625 direct costs, North Central 898 in for total costs. That's total economic costs, land, labor, everything involved. Center pivot systems in the Southwest numbers. Forward contract for beans 1167. Put floor, it's costs about 90 cents to buy a put option. And immediately our cash flow consciousness would say, forget it. But let's just see if it, do we spend that much money? Marketing alone against 621, Salina County, really not in the game right now. But it is interesting. The marketing loan covers the direct costs pretty decently, but it's not covering land costs. And you've got the same situation here. There's that 1187 is the projected price. Crop insurance, again, 85% of that's 1009. So, in a normal, if we weren't looking at $12 and $13, we'd see that 1009 and think, my gosh, that's a great price. and up until this year, last year or so, it was. But that's what we have now with this higher projected price that the USDA's come up with. And then you have, again, same PLC 840 RP reference price. And again, basically, we've got to crunch below that before we start seeing anything. So again, kind of focusing on Salina again. And I'm putting in there a range of from 740 to 1240. And who would argue, given what's happening in the export markets, that nobody be surprised. They probably have a greater expectation of 1240 than 740 until some conflict would happen. And Greg had mentioned volatility could come into the market. It could all be there. But so that there's that 1009 our 85% APH, 100% acreage coverage, distributed price, total cost $8.98, basically $9, and the 75% RP basically covers that. You go to the next issue though, and so there's that. I think what discourages us in the bean market is that we see current prices 13, 14 bucks. We see new crop bids at 11.60, and it's pretty disappointing relative to where we're at. But large crops coming on both South America and in our shop, for at least some proportion of our marketing, this is something to consider. So here you have costs about $9, put floor 1076, forward contract 1167. So it looks like that we have prices out there. We have new crop bids that are giving us something to at least consider for forward pricing for this coming year. Returns of not just 1 or 2%. We're talking about 10, 20, 30% over our expected costs. And even if that's $9.50, still you're at more than $1.50 or $2 over these prices. The only thing that holds us back is just the fear of missing out on something better, or the fear of getting the crop planted and up. That's relevant too. And so anyway, I think with that, Rich, in that presentation, I do have explanations of the paper for both corn and soybeans, basically saying what we had just done. And if people can read through that, or if I'll sure stay around if people want to talk some more about that and ask questions, yeah, let's discuss it. But with that, I think our time is what we had promised is getting pretty close to